What's up, guys? This is Manoj Chopani. I welcome you all on behalf of the Edupedia world. Structure of mutual funds in India. So, guys, this topic has already been covered in my second presentation. However, this topic will again be covered because I have to discuss with you the most important elementary parts which are available in a structure of mutual fund, and those are sponsors, trustee, and custodian. So we'll be dealing and discussing about these three components of mutual fund schemes in detail. So we'll begin with sponsor first. So sponsor is basically a person who is responsible to float a mutual fund. He has to put on his 40% net worth in order to set up a mutual fund. What is sponsor? So sponsors should have a very sound track record as far as the reputation of fairness and integrity in his business transaction is involved. He should have sound kind of track record. And now you must be pondering about the fact like what is sound track record? So let's discuss about what does sound track record mean. So that means sponsors should be carrying on the business of financial service for a period more than 5 years. He should have that kind of stability in financial services business. He should be having a net worth which is positive in all the immediately preceding 5 years. So guys, that's another important imperative step which does depict you about his sound track record, that he must have that kind of net worth which is always positive in all the immediately preceding 5 years. Apart from that, his net worth of the immediately preceding year is more than the capital contribution of the sponsor in any asset management company. So he has to ensure that his total net worth of immediately preceding year is actually more than the capital contribution of the sponsor in the asset management company. The sponsor has profits after providing for depreciation, interest, and tax in 3 out of immediately preceding 5 years, including the 5th year. Apart from that, a sponsor needs to be a very fit and a proper person if he is an individual. If in case that's a company, still, as a company, it needs to be a fit and a proper person. The sponsor or any of its directors or the principal officer to be employed by the mutual fund should not have been guilty of any kind of fraud or have not been convicted of any offense which involves moral turpitude or hasn't been found out guilty in any of the economic offense. So that's the most important condition in any of the cases. Like if the ethics and morality is concerned, so he must not have been like guilty of any kind of fraud, must not have been convicted in any of the offense which involves the moral turpitude, or shouldn't have been guilty of any kind of economic offense. So guys, if we'll be taking out the example for that matter, we can just say in case of Reliance Mutual Fund, Reliance Mutual Fund has been sponsored by the Reliance Capital Limited and Nippon Life Insurance Company. So here in this case, Reliance Mutual Fund is a mutual fund and the sponsor for the same is Reliance Capital Limited, plus there is a life insurance company which is named Nippon Life Insurance Company. These two companies have actually been the sponsor for Reliance Mutual Fund. And as far as the condition of like taking into account for UTI Mutual Fund, we can say it has been actually sponsored by 4 of the largest public sector financial institutions. One is State Bank of India, another one is LIC, Life Insurance Corporation, another one is Bank of Baroda, and the last one is PNB. So these 4 largest public sector financial institutions are taken care of as the sponsor for UTI Mutual Fund. So guys, that is how mutual fund actually works in terms of taking care of it as a sponsor. So sponsor has a very imperative and an important kind of availability in this mutual fund scheme, and he has to actually ensure that he do follow this kind of sound track record in order to ensure that the mutual fund business runs in a great manner. So now let's jump on to another topic, trustees. Who are the trustees? Trustee means a board of trustee or a trustee company who holds property of mutual fund in trust for the benefit of its unit holders. So basically that can be a board of trustee or a trustee company who actually holds the property of mutual fund in the form of trust for the benefit of its unit holders. If in case you are directly investing in the share market, then you are called the shareholders. If in case you are investing through mutual funds into share market, then for mutual fund companies, you will be taken care of as their unit holders. So trustee do take care of the property which is being insured in the mutual fund as in the form of trust for the benefit of its unit holders. So what is the eligibility of its appointment? Mutual fund shall appoint trustee in accordance with mutual fund regulations. Apart from that, no person shall be eligible to be appointed as a trustee unless he is a person of ability, integrity, and understanding. He should not have been found guilty of moral turpitude, has not convicted any kind of economic offense or violation of security laws, and has furnished his particulars in the specified Form C. So that is basically a kind of form which is being taken care of, that whether the trustee is basically providing the regular statutory compliances or not. So that is the Form C, in which it mentions the details regarding the mutual fund companies time and again. Apart from that, an asset management company or any of its officers or employees shall not be eligible to act as a trustee of a mutual fund, and has to ensure that these two are the separate legal entities. And in order to ensure unbiasedness and transparency in the work, absolutely no employee or officer which is being associated with an AMC shall be eligible to act as a trustee of a mutual fund. It has to be ensured. Apart from that, no person who is appointed as a trustee of a mutual fund can be appointed as a trustee of any other mutual fund unless such a person is an independent trustee and prior approval of the mutual fund of which he is already a trustee has been obtained for such appointment. So if in case one is appointed as a trustee of two of the mutual fund, then in such a case one has to ensure that he or she must be an independent trustee plus the prior approval from the mutual fund in which he has already taken care of as a trustee has to be obtained before such an appointment in the second mutual fund company. 2/3 of the trustees shall be independent persons and shall not be associated with its sponsors or be associated with them in any manner whatsoever. In case a company is appointed as a trustee, then its directors can act as trustees of any other trust, provided that the object of the trust is not in conflict with the object of the mutual fund. So guys, if we'll be considering the practical example of trustee, I can tell you one thing. Like in case of HDFC Mutual Fund, HDFC Mutual Fund is having HDFC Limited and Standard Life Investment Limited as their sponsor and HDFC Trustee Company as its trustee. So here we can take care of one picture, like if there is a mutual fund which is HDFC Mutual Fund, it is having its sponsors as HDFC Limited and Standard Life Investments Limited, and a trustee company that is HDFC Trustee Company Limited. Though it has been like in the kind of negotiations and they have already entered into an agreement with Morgan Stanley as well regarding the same things to take care of their mutual fund in a better manner. That's more concerned with the practical knowledge, what's going on in the market. So relatively, that's more than sufficient for you guys to understand the similarities which are being involved and what is trustee mean. What does trustee mean actually? So now let's move to the third important segment of the structure of mutual fund, and that is role of a custodian in a mutual fund company. The mutual fund shall appoint a custodian to carry out the custodial services of the scheme for the fund and shall send the intimation of the same to the board within 15 days of the appointment of the custodian. In case of dematerialized securities that are being held in demat form, the holdings will be held by the depository through depository participant. So a mutual fund should appoint a custodian for the schemes of the fund, plus the intimation for the same is to be sent to the board within 15 days of the appointment. In case of demat securities, holdings will be held by the depository through depository participant. So guys, that was about the appointment of custodian. Now, if in case absolutely no custodian in which the sponsor or its associates hold 50% or more of the voting rights of the share capital of the custodian, or where more than 50% of its directors and custodian represent the interest of a sponsor or its associate, shall act as custodian for a mutual fund constituted by the same sponsor or any of its associate or subsidiary company. I know it's a bit of a problem. So we can just summarize this particular point with simply saying that no custodian can hold more than 50% or more of the voting power in sponsor company, and no sponsor company can hold more than or equal to 50% of the voting power in custodian company. So that way it's going to ensure that there is an unbiased kind of work and the process is absolutely transparent. So that is how it works. So if in case we just take out an example, practical example relating to custodians in the market. So there is a company which is known as CAMS Investor Services Private Limited. So that is being taken care of as a custodian for many of the mutual funds available in the market. So we have Birla Sun Life, we have HDFC Mutual Fund, we have HSBC Mutual Fund, we have L&T's Mutual Fund, we have IDFC's Mutual Fund. Apart from that, we have Kotak's Mutual Fund. Apart from that, we have SBI Mutual Fund, we have ICICI Bank Mutual Fund, JP Morgan's Mutual Fund, IIFL's Mutual Fund, Tata's Mutual Fund. All these mutual funds have actually appointed custodian as CAMS Investor Services Private Limited. So this is the company which is providing the services of custodian to all these mutual funds in maybe some proportion or maybe completely over there. So that is the practical kind of exposure which will be provided to you while having that kind of conversation regarding the topics. So guys, that was all about the three important segments which are being involved in structure of a mutual fund company. One was sponsor, another was trustee, and the third one was custodian. So one must have the overall knowledge of how a mutual fund company works. And in order to provide you the same kind of clarity with theoretical as well as the practical market knowledge, I have actually incorporated these segments in my presentation. And I'm sure you must have got the entire clarity regarding the structure of a mutual fund in India. So now let's jump on to another topic, and that is selection of a mutual fund for investment. That is actually a very practical kind of a topic which needs to be learned, not just for the theoretical or exam perspective, also if in case tomorrow you start investing in mutual funds. So what are those parameters that you will be actually vouching out for the accuracy and effectiveness of a mutual fund while deciding which mutual fund to go for and which one to not? So the first one comes into the picture, and that is past performance. So guys, in any case, though I believe that NAV, particularly net asset value, is a yardstick for measuring the monetary returns, but the real performance should be gauged with respect to the benchmark which the overall market returns are providing during the period which may be under evaluation. So one has to consider the past performance of a mutual fund while selecting whether to go for that mutual fund or not. Next comes into the picture, that is timing. Timing is extremely important. Generally, mutual companies usually collect more money during bullish times because the market is going up, and shies away from the market during bearish times because certainly market is going down, and most likely not much of the people or many of the people are willing to invest in the stock market. So during that amount of time, they usually don't go for collecting enormous amount of money from the market. So it should be other way around actually, as far as the growth or investment is considered. Because when the market is going down, that should be the most appropriate period for you to invest. And whenever the market goes bullish, that means if the market goes up, then you'll be able to extract great amount of returns. You can purchase at a very low price and you can sell out at a very high prices for that matter. Usually that happens, but generally mutual fund companies usually do other way around. So one has to take care of these things. Usually novice kind of investors who like started investing in the market should not attempt to time the markets in that manner. They go with their particular timing which is being provided by the mutual fund companies, and thereby they'll be able to extract good amount of returns because the knowledge which is being provided and imparted by the portfolio managers would be indifferently better than many of the persons who are like starting afresh in the market. So timing has to be considered in that way. So now the third point comes into the picture, that is size of the funds. what is the size of the fund that you as an individual are willing to invest. Preferring a large size mutual funds may not be advisable, as it may be difficult to build an attractive portfolio easily owing to its sheer demand for stocks. Time may run out in such a cases, or market liquidity may forbid construction of a quality portfolio. In such a case, of small funds, a big redemption may tilt the performance in a big way, and therefore, medium-sized funds should be preferred. So, don't go for very extremely high funds. Don't go for extremely low funds, because you won't be able to extract good amount of returns with extremely high funds, because there will be many of the people over there. And in case of low funds, there are chances that your valuation and the kind of money, hard earned money, which you will put in the mutual fund segments, that may not be able to extract that kind of good amount of return. So it's always better to invest in a medium size funds so that you can extract the good amount of returns for your investment. Next comes into the picture, that is age of fund. So age is extremely important while selecting a mutual fund or investment. Longevity of a fund in business needs to be determined, and its performance in rising, falling, and steady markets have to be checked. Pedigree does not always matter, guys. So one has to take care of these things. Age of a fund is actually important while going for the selection. Longevity of a fund in business needs to be determined, and its performance in rising, falling, and steady markets have to be checked regularly for that matter. Next comes into the picture, that is largest holding. A look has to be made at the portfolio would actually reveal the largest stakes of entire mutual fund houses in a particular group of company. So let's suppose today we have Reliance Mutual Fund, and somehow they are having their most holding in their mutual funds with Reliance Capital Limited. So that will show that certainly that kind of company is believing that the share market will go in a beneficiary condition for Reliance Capital Limited. That is why it has actually invested its largest amount of holding with that company. Though it's a kind of like group company only, because Reliance Mutual Fund and Reliance Capital Company, they both are having sponsors. This kind of situation may not prevail in this particular segment, because there is some certain restrictions that the sponsors won't be able to list out their securities with the mutual fund. But having said that, one has to take care of these kind of measures, whether the company is having, which kind of company is the mutual fund has mostly attached its funds to in the form of stock market issues. So cognizance should be given to this fact as well. So what is the largest holding for your mutual fund? Apart from that, a fund manager is an important person. One has to take care of him, this fact as well, because not all the management, not all the fund managers which are available in the market today are equally competent, and certainly one has to check out this kind of fact as well, whether the selection of mutual fund should be based on the fund manager of a company or not. It might be possible that the fund manager who is associated with Reliance Mutual Fund would be better than UTI Mutual Fund, and the fund manager which is associated with UTI Mutual Fund may be better than the IDFC mutual funds. So that can be a chances. And how this performance basically is measured with the overall NAV and the kind of growth and the attractive returns a fund manager is able to extract and provide to its unit holders. So certainly, if today I join as a fund manager of a company, in such a case, my credibility as of now would be extremely less to a person who is like already paying out good returns for another mutual fund who is already existing in the market. So that's how this scenario for fund manager actually works. Next comes into the picture, that is expense ratio. Guys, while investing in the mutual fund, one has to take care of the expenses as well, because not all the mutual fund companies charge the same kind of expenses. In such a case, one has to have that kind of overall idea who is actually handling the fund management of the company. So there might be a chances that the expenses and the ratios, which expenses basically will be higher in case of one mutual fund, and the expenses in another mutual fund would be lower than that. So one has to check out for these kind of expense ratio parameters as well, because certainly you won't be feeling good about losing on the opportunity cost that you'll be losing on terms of expenses. So lesser the expenses, better in that case would be. However, the other parameters which are being involved apart from expenses cannot be denied in that case. So one has to look for the overall portfolio and the overall benefits, taking into consideration each and every selection parameter which has been told by me to you. that is past performance, timing, size of funds, age of fund, largest holding, fund manager, as well. So in such a case, one has to actually look for and have an idea of a person who is handling the fund management. A person of repute usually take care of, like SEBI has already laid down the upper ceiling for expense ratio. A lower expense ratio will actually give you a higher return, which is always better for an investor. Now comes into the picture, that is PE ratio. So PE ratio basically talks about what is the kind of price and what about the earning you'll be able to extract by paying that price. So today, if I am like paying 100 rupees to someone, and if he is providing me an earning of rupees 10, so I can simply say that the PE ratio would be 100 divided by 10, that is 10:1 in such a case. So simply we can say that if I'll be investing rupees 10, I'll be getting a return of rupees 1. That's how PE ratio works. So PE ratio for securities in mutual fund portfolio should be studied to identify the risk levels in which mutual fund operates. And without denying the fact, it's simply said PE ratio should be taken care of in such a cases, right? Perfect, guys. Apart from that, there is last parameter which is involved, and that is portfolio turnover. Portfolio turnover basically indicates the frequency at which the fund manager buys or sells the stocks needs to be studied. And higher number would indicate frequent trading and high costs. And lower number would actually indicate an ineffective and inactive kind of fund manager and possible loss of attracting opportunities. So you should have that kind of balance while selecting for a particular mutual fund, that the kind of company you'll be investing. So it's better to invest in a kind of company that has aggregated medium kind of like average kind of portfolio turnover, neither so less nor so very high. So guys, that's how this particular segment and this topic works. One has to go for all these parameters: past performance, timing, size of funds, age of fund, largest holding, fund manager, expense ratio, PE ratio, and portfolio turnover while while actually selecting any kind of mutual fund for investment. So guys, I hope you got the entire clarity about this topic as well. Now let's jump on to our next topic, and that is signals for exiting a mutual fund scheme. I have just told you about entering of a mutual fund, how to go for those kind of parameters by entering the market. Now, I'll be just discussing with the signals actually which are being involved if a person wants to exit the mutual fund scheme, or there is a sign that one has to and one should. There might be a chance when a person may not be willingly like outperform or maybe get out of the market, but certainly in such a cases one has to take care of these cautious things which are revolving in the market, which deemed to provide as the signals for exiting in the market scheme, mutual fund one. So that is the consistent underperformance against the benchmark. Guys, if you have already invested in X mutual fund company and you are already watching out the market, and you can easily say that while investing in X market, the Y mutual funds rate was something a way better than that, though you started out with X1. However, you can simply see that X is day by day and day in day out actually it is consistently underperforming against the benchmark. Other mutual funds are growing high and your mutual fund is not growing at such a pace, or maybe averagely performing. Then it's a chance and it's a signal which actually you have to assure and adhere to during that moment of time, just to ensure that you don't suffer in case of their underperformance. It's a time to exit the market with that mutual fund. Apart from that, there is a consistent underperformance against the peer group. Benchmark goes with index. So if NSE is having like something return and you are underperforming to that, NSE is having like 1,000 rupees NAV and you are dealing out with like 200, 300, 400. So that is like consistently not performing in comparison with benchmark. However, if HDFC mutual fund can be categorized with UTI mutual fund or with IDFC mutual fund or with Kotak mutual fund, then in such a case, the consistent underperformance against the peer group, we can just ensure with those four mutual fund companies that whether we are able to extract good amount of returns or not. And if in case we are not able to extract the good amount of returns, so why are we consistently underperforming in such a case? And if in case you get to know that yes, you are surely underperforming time and again, and that too consistently, year to year, then it's the right move to exit that mutual fund scheme. In case, that's the third reason, in case the objectives of the scheme do change. You being an aggressive investor, you want your mutual fund company to invest more in equity, less on debt, because you are able to take more risk in that case. And in such a case, maybe let's say tomorrow the company starts investing more in debt securities, maybe to ensure fixed kind of return, and may not aggressively perform during those days while making their holding less in equity related instruments. In such a case, you won't be able to meet the objective with which you started investing in that mutual fund scheme. So somehow the company is actually changing its plans and its objectives of the scheme. So that will be a right move to exit the market and exit that mutual fund scheme if the objectives of the scheme changes. Next comes in the picture, that is change in the composition of portfolio. So you started with Reliance, HDFC, and Tata, big giants over there, and these are the big blue chip companies overall. And certainly in such a cases, you have already invested more of your equities in these companies rather than going for penny stocks or small cap companies. But somehow tomorrow you feel that the company, mutual fund company, has actually started uh, liquidating their holdings from these companies and have started more investing in small cap companies or penny stocks. Then in such a case, since the composition of the portfolio is changing and you are not pretty much sure or you are not satisfied with the kind of holding in such a case, then it's a signal to exit the mutual fund scheme. Apart from that, there is a change in the fund management style. Like manager used to perform very good earlier. They used to extract good amount of returns for you, and somehow they have actually changed the kind of working, and management has started taking more risk, which may be a case that you don't find yourself fit to in such a case, and you don't want to take more risks. Then in such a case, that's a signal for exiting the mutual fund scheme in that case, because there is a change in the fund management style. Apart from that, there is a change in sponsor. Suppose you actually started investing with the view that this sponsor, maybe like Reliance Capital Limited, or we can say that these four financial institutions, which we just discussed in our last slides, you actually started investing just due to the fact that they were involved in that mutual fund schemes. So on their behalf, on the credibility of them, on their good reputation, you started investing. And somehow tomorrow there comes into the picture that those sponsors change. And there might be a chance that you won't find any kind of credibility of the new sponsor. And in such a case, definitely it's a signal to exit the mutual fund scheme. And last but not the least, change in the strategy of investor. Yes, till yesterday you were more keen to invest in debt securities. So you started out your mutual fund scheme with a kind of mutual fund that invests more in debt securities rather than equity. But let's say today you have started feeling aggressive and you certainly want to go for the kind of risks in your life, and you have actually changed your strategy that now you'll be investing more in equity rather than debt security. And in such a case, this existing mutual fund scheme won't be able to provide you much of your expected returns. Then it's always better to exit that mutual fund scheme and enter into the one which provides you more of equity and less of debt, so that you can take the advantage of more risk and aggressiveness in terms of higher returns. So guys, that was all about the signals for exiting a mutual fund scheme. So underperformance against benchmark, underperformance against the peer group, change in the objective of schemes, change in the composition of portfolio, change in the fund manager style, change in sponsors, change in strategy of investor. So I just believe that you got the entire clarity about this topic as well. So now let's jump on to our next topic, and that is investment options in a mutual fund. So guys, let's discuss about the investment options that are available in a mutual fund scheme. These are primarily four: dividend payout option, growth option, dividend reinvestment option, and bonus option. So guys, in case of first, we'll be taking into account that is dividend payout option. So guys, in case of dividend payout option, When a dividend option is chosen, the investor gets to cash in on the returns earned by the fund from time to time. They simply accept the kind of dividend which a company usually earns during its entire period from time to time. They don't believe in any kind of reinvestment. They don't generally believe in any kind of growth. They don't likely believe in any kind of bonus. All they want is that they should have their regular income in the form of dividend. Whatever the company is earning all during the year, they should simply provide that earnings in the form mostly as dividends. So this particular option is best for elderly people who are already retired from their businesses, already retired from their services, and they want to have that kind of regular income for themselves in order to take care of them. Then in such a case, dividend payout option is actually best for the people who are uh, aged more than 60 years for that matter. So now let's move to growth option. What is growth option? In case of growth option, if that is chosen, the returns earned by the fund are retained and reflected as an appreciation in the fund's net asset value. So basically, here you won't be able to get any kind of return in terms of dividend, basically. So whatever the kind of returns the mutual fund company usually earns, the same are retained and reflected as an appreciation to the fund's net asset value. And they keep on growing. And at the time you exit during the mutual fund scheme, you get the entire benefit of that growth which has actually happened. So in any of the cases, the kind of NAV which you'll be getting in growth option will absolutely be greater than the one which you'll be getting in dividend payout option, because certainly you are not getting any kind of dividend in such a cases, and you are just reinvesting that growth parameter. So now let's talk about dividend reinvestment option. So under the dividend reinvestment option, the investor authorizes usually the fund to plow back the dividends which are declared by the funds at the prevailing NAV, fetching him more units. In other words, I can simply say that instead of paying the dividend, additional units are purchased and put in the investor's account at the revised NAV. This is actually guys, I know that you'll be having this kind of perception that don't you think so that growth and dividend reinvestment option are pretty much same? Yes, they are similar, but possibly with the different tax liabilities. If you'll be considering reinvestment option, you can simply say that you won't be getting any kind of dividend apart in comparison with the dividend. That same dividend will be reinvested at the revised NAV. And however, in such a cases, that will likely to grow slowly. In case of growth option, there is nothing called dividend into the picture. You just simply get those kind of returns in terms of overall growth. And in such a cases, the NAV, we can simply say that the NAV of a growth option will actually be greater than the NAV which will be available in the market in dividend reinvestment option as well. These both the things are similar to each other, however, possibly with different kind of tax liabilities. In case of bonus option, under this basically, which is similar to kind of dividend reinvestment, investors are allotted bonus units instead of dividend. The simple difference between the two, that is dividend reinvestment and bonus option, is that investors are allotted bonus units instead of dividend. The issuance of bonus units will not impact the value of holding, but will only increase the number of units which are held by the investors. However, pursuant to the allotment of the bonus units, the NAV of the scheme will definitely fall in proportion to the bonus units allotted. And as a result, the total value of the units held by that person would actually remain the same. So guys, the crux for all these four options and four investment options that are available in the mutual fund would be that the NAV of a growth option, will always be higher than that of the dividend option, because money is going back into the scheme and not given to investors. NAV of dividend and dividend reinvestment plan would be same after the distribution of dividend. There will always be separate declaration for NAV for dividend, growth and bonus plans, and all these will be different once the dividend and bonus has been declared. So that was the crux which we can develop with the investment options that are available in the mutual fund scheme. So now let's jump on to another topic of ours, and that is expenses of a mutual fund. So what are the kind of expenses which are being involved while investing in a mutual fund scheme? So guys, primarily there are just two. If I'll be like having, I'll have to categorize the expenses of a mutual fund in just two categories. That would be initial expenses and recurring expenses. On a simple note, but what's being included in recurring expenses? What is being taken care of as in individual, like first initial expenses? That would be firstly, in case of initial expenses, the same is attributable to the establishment of the scheme of mutual fund. This is actually like similar to preliminary kind of expense of a corporate. Simple initial kind of expenses, preliminary expenses. The first thing. Earlier, we used to call these initial expenses were booked in a respective scheme account and which were called as load. That is entry load. Usually people used to call that. So load is basically the amount which is paid by the investor to subscribe to the units or to redeem those units from the scheme. Simple, fine enough, perfect. This amount is used by the AMC to provide commissions to the distributor and to take care of other marketing and selling kind of expenses which are involved in the scheme. Load amounts are usually variable and subject to change from time to time. So SEBI with their help of their circulars usually amend those kind of expenses on load from time to time. So that might be like something like 1% or might be like something 2%, and it changes gradually with time to time depending upon the inflation and other interest rate factors available in the market. So the upfront commission, which if any kind of on investment made by the investor shall be paid to the investor directly, shall be paid by the investor directly to the distributor based upon his assessment of various factors, including the service rendered by the distributor. Let's suppose to say that. Okay. In such a case, initial issue expenses are usually borne by the investment manager or AMC and not by the scheme of mutual fund. So it has to be like directly extracted out of the pockets of the investor only in such a case. So initial expenses basically means load. Load means any kind of amount which is usually paid by the investors to subscribe those units or to redeem those units. That may be entry load or exit load in such a cases. And this particular load usually is extracted from the pockets of investors to take care of the commissions which are likely to be paid to the distributors or any kind of marketing or selling expenses. So that was the initial expense, guys. And if we'll be taking care of recurring expenses, there are a few expenses which are regularly likely to be borne by the AMC. These are basically day in, day to day expenses which are usually spent in running a mutual fund scheme. The total annual recurring expenses of the scheme, excluding any kind of deferred revenue expenditure which is written off, or issue or redemption expenses, but certainly including the investment management and advisory fees, are classified as recurring expenses. And the same can be charged to the scheme, but should be within the limits which are being specified in Regulation 52 of SEBI regulations that you will be covering with your segment in corporate law. So the recurring expenses usually chargeable to the scheme are investment management and advisory fees, any kind of cost which is being paid towards investor education and awareness, trustees fees, audit fees, custodian fees, RTAs fees, like marketing and selling fees, cost any kind of cost that is related to the investor communication, any kind of cost which is available in transfer from location to location, any kind of cost that is available in statutory advertisements, any kind of brokerage or transaction cost over and above, any kind of service tax which is being paid on expenses other than investment advisory fees, and so on, so on, so on. That is like an unending kind of expenses process. So most likely you will just have to remember that in a broad guidelines, they are investment management fees, trustee fees, audit fees, custodian fees, brokerage, sales and marketing expenses, RT fees. So what an investor usually have to do? Investors generally look for the total quantum of expenses through a measure that is called expense ratio, which has already been covered by me in the last slide. That was for selection of investment. So while selecting any kind of mutual fund scheme for investment, one has to take care of expense ratio. So which is usually provided by a simple formula, that is expense per unit divided by average net value of assets. Expense per unit divided by average net value of assets. So the maximum total expense ratio, which is available and permissible under the 52 regulation, is up to 2.5% of the daily net asset scheme. And it is likely to be noted, guys, that the expenses exclude any kind of brokerage which is incurred while doing any kind of sale or purchase of securities, as sale and purchase are recorded on net basis, and has to take care of that fact. That's an additional kind of information that I am providing you. So that was all about the topic relating to expense of mutual fund. So guys, that was all about the topic relating to expenses of mutual fund. Now we'll be just discussing about one of the most relevant topic for this presentation, and which has already been asked in CA final examination twice, May 2010 and November 2013. So as far as the theory portion is concerned for this chapter, this question has already been asked twice in CA final examination. And this topic is basically not just important for your theoretical or your exam related knowledge, but also your practical knowledge, because this is a kind of funds which are actually trading good in today's market. Mutual fund schemes, people are resorting to this exchange traded funds rather than going for any kind of mutual fund schemes. So what is basically this exchange traded funds? We'll discuss about this. So guys, an ETF, an exchange traded fund, is basically a hybrid product which is having the features of both an open-ended mutual fund scheme and an exchange listed security. We can simply say an ETF is a product which is having the combination characteristics of a mutual fund scheme as well as that of a share. We can simply say that. An ETF is a fund that trades and tracks an index that can be traded like a stock simply. So that's an added advantage in such a case. It is a fund which usually tracks the index. Index basically that is National Stock Exchange and Bombay Stock Exchange, that is for Nifty and Sensex. But the same can be traded like a stock in such a cases. ETF money is invested in the stocks of the index in the same proportion. That is the quality with this. Apart from that, exchange traded funds are traded on stock exchanges. ETF units may be traded at a premium or discount to the underlying NAV. So guys, that was all about the topic relating to what is exchange traded funds. I would like to reiterate this topic to you again because this has already been asked twice in the CA final examination. So ETF is basically a hybrid kind of product which does provides you a feature of both an open-ended mutual fund plus an exchange listed security, that is a share and a mutual fund scheme. So it is basically a fund that tracks an index. So simply we can say that if the market scenario or market economy goes up, so Nifty and Sensex goes up, and with Nifty and Sensex going up, definitely exchange traded fund will also go up. So that can be simply aligned that we are particularly not investing in any kind of security, rather we are just investing in directly in index. So if the index will go up, we'll be able to extract good amount of returns in terms of profit. And if the overall economy goes down, index will go down, our exchange traded fund scheme will also go down. In such a case, we'll have to bear some losses. So we can simply say that our position will be likely aligned with being directly proportional to what an index and how it is moving. Simply we can say put in those words. So it is actually a fund that tracks an index, but the same can be traded like a stock. You can easily purchase it from stock exchange, and whenever you wish to, you can sell them. ETF money is invested in the stock of exchange index in the same proportion, which has already been discussed with you. And certainly the ETFs are traded on stock exchanges. That is the best kind of form. They can be bought or sold at any time during the day, unlike most mutual funds which do not provide you such option. Their prices will actually fluctuate from moment to moment, just like any other kind of stock price. So you can have that kind of feature that you are actually trading a stock only in the form of ETF. Apart from that, ETF units may be traded at a premium or discount to the underlying net asset value. This difference in price may be due to the forces of demand or supply for ETF in the market at that point of time. So that can be said like that only. And an investor will actually have to have the need to have a broker in order to purchase or sell securities. So one has to take care of these things as well. So this is the best kind of investment that is available in the market today, and you can extract the benefits from these as well. So tomorrow, if you get an opportunity for investing in a mutual fund or an exchange traded fund, my opinion will always go for exchange traded fund, and that too for with a sole perspective of holding those funds, holding that investment for a longer period of time. You never know, guys. If today you are investing just 10 rupees, 20 years down the line, if you'll be able to take care of that, that might be a chance that those 10 rupees may change into 2000 during those 20 years. And that will be in any way better than any kind of return, FD return, mutual fund return that will be provided by these kind of investments. So you never know, because you are generally expanding with the economy of the nation, and India is one of the superpowers in terms of current developing countries. India can serve as a superpower in a very near future, and certainly all the economists and all the world leaders are helping out India in growing at a great pace. Modi ji has also started their Make in India over there. So certainly, if the stock market is going to get up in any of the cases, certainly the exchange traded funds are the best sources for investment in such a case to extract the best returns which are being provided in the securities market. So now let's discuss about what are the ETFs in India. I have included this into my presentation in order to provide you an examples. So what are the ETFs in which you can invest? So these are gold ETF, liquid ETF, index ETF, and international index ETF. So what is gold ETF? So basically, this kind of ETFs invests in gold market. We all know that gold is one kind of metal, one kind of a commodity that helps us in extracting the best of the returns. And certainly, Diwali is coming pretty near, so we can easily say that most of the people have actually started investing in gold, or they have already bought the gold in their kitties, just to ensure that by the time Diwali comes in, definitely the market prices of gold will go up, and they'll be able to extract good amount of returns from that investment. So certainly these ETFs do invest only in gold related securities or bonds. Apart from that, we have liquid funds. Liquid ETF basically invest their investment holdings in those liquid instruments that are readily available in the market, and from where we can easily be able to extract our income. So that provides us a liquidity kind of feature. So liquid ETFs usually invest in those kind of securities which can be easily liquidated, like commercial papers, certificate of deposits, and related things, treasury bills, 90 days T-bill rates, these kind of things. So as to ensure that whenever the customer or investor, I can say, needs any kind of returns, those actually ETFs can be easily extracted during that point of time, and they will be able to provide good returns in such a case. Apart from that, there we have index returns that I have already discussed with you. In ETFs which are like specifically providing their investments in Nifty, Junior Nifty, Bank Nifty, and PSU banks, Sharia. We'll be discussing about that one by one. So ETFs which are directly investing all of their investment in Nifty. So they'll be getting an amount which is equivalent to, if Nifty goes up, their return will also go up. If Nifty goes down, their return will also likely to go down, because they have directly invested in index rather than going for any of the option for investing in different securities. So that way they are growing with the economy and they are losing with the economy. So that can be simply said, because India is a growing economy, so definitely one will be getting the benefit of investing in exchange traded fund with respect to Nifty. In case of Junior Nifty, Nifty basically holds the position of top 50 companies in case of market valuation. So that includes Infosys, ITC, L&D. Many of the companies are being included in top 50. Junior Nifty basically goes for those companies that are ranked from 51 to 100 in terms of overall market capitalization. So these companies are aggressive as compared to the ones which are in top 50. Top 50 are basically growth companies, yet they are stable in their nature. However, Junior Nifty basically allows you to go for a position of investing in those kind of companies that are likely to provide you a higher return, because a bit of risk is always involved in them, because certainly they are not the best of the companies in terms of top 50 are involved. But yes, Junior Nifty does provide you a good amount of returns as far as the Nifty is concerned. So many of the people actually appreciate the fact that the index ETFs should provide such kind of segments also where they can invest in 51 to 100 companies rather than investing in first 50 because they get better returns with those. Bank Nifty usually provides you an option for investing directly only in those bank related instruments like PNB, SBI, BOB, Union Bank of India, these kind of banks. So basically ETFs which are investing specifically allotting their investments in these bank nifties are usually called bank nifty index ETFs. Apart from that, we have PSU banks. Now, if a person is just investing only in public sector units, banks, then that will be dedicated investment for only PSU banks. In such a case, that ETFs won't be allowed to any kind of make investment in uh, private related banks like HDFC, ICICI Bank. So they'll be dedicatedly having their investments in only PSU banks. Apart from that, there is one Sharia investment. Sharia is basically an Islamic kind of law. Islamic laws and Islamic kind of laws are already provided some of the companies in which this Sharia law applies. So the ETFs which are specifically and dedicatedly having their investments only in those companies which are approved by Sharia law will be called Sharia index ETFs. Apart from that, we also have some two of the international index ETFs that are Hang Seng and S&P CNX 50. S&P is basically a credit rating agency which is prevalent outside India, that is Standard and Poor's. We have an organization which is providing data to many of the companies, which is called S&P Capital IQ. The location is also available in Delhi for that matter, in Gurgaon. They are having their office in DLF Cyber Hub. So they also provide us the data related information with the financial statements of various companies. All their data solving problems can be easily taken care of by Capital IQ, S&P Capital IQ. So the indexes which are prevalent outside India are Hang Seng and S&P CNX 50. So these are the investments which can be easily made in ETFs in India, or the ETF indexes which are prevalent outside India, but the same are being investments can be easily made in India as well for that matter. So guys, that was all about the topic relating to ETFs, and their practical scenarios have already been discussed with this presentation. I hope you got the entire idea about not just theoretical knowledge, but I was able to provide you a practical knowledge as well relating to market fund investments. We'll be concluding this presentation with the last topic of today, and that will be ETF versus open-end funds versus closed-end funds. So we can simply say about the parameters, open-end funds, what's the benefit of having open-end fund, what's the benefit of having closed-end fund, and what's the benefit of having exchange-traded funds. So we can simply say the fund size in open-ended fund is flexible. However, in that case, in case of closed-ended fund, the fund size is fixed. In case of exchange fund, since the same is being traded likely day in day out on stock exchanges, the fund size is flexible in that case. NAV in case of open-ended fund is changing on a daily basis. NAV in case of closed-ended fund is also changing on daily basis. However, in case of exchange-traded fund, you get an opportunity to trade like a stock rather than a mutual fund. So in that case, the NAV is actually going real time, not just at the start of the day and at the closing NAV. You get a chance to track your ETF day in day out on real time basis. So whatever the market is going on, definitely you'll be able to extract the good amount of return on the same point of time, rather than you don't need to wait for the closing NAV for that matter. So that's an advantage with exchange traded fund. In case of liquidity provider, open-ended fund is a fund in itself. Closed-ended fund acts like more like a stock market in terms of that, and exchange traded fund basically provides you as a liquidity provider for stock market as well as the fund which is being in itself. Sale price for an open-ended fund would be NAV that you'll be able to get plus the kind of load that you'll have to pay, if any, in such a cases. Closed-ended fund usually provides significant premium and discount on NAV. As far as the exchange traded fund is concerned, it is very very close to the actual news stream. So that's a good part about exchange traded fund. Availability, if we'll be considering in such a case, for open-ended fund that will be fund itself, and for closed-end fund that will be through exchange wherever it is listed, and an exchange traded fund that will be through exchange along with the fund itself. So here you get an opportunity again. Plus, if we'll be talking about the portfolio disclosure, An open-ended fund is required to provide a portfolio disclosure on a monthly basis. Same goes with closed-ended fund. However, in case of exchange traded fund, you get you get a better option as investor, because you'll be able to get the portfolio disclosure on a daily or real-time basis. That's an added advantage with exchange traded fund. And in case of intraday trading, certainly in case of open-ended fund, that will be not possible. In case of closed-ended fund, that will be too much expensive. And in case of exchange traded fund, because the same is traded just like any other stock in the market, so you can simply have it possible at a very low cost. So intraday is extremely possible in case of exchange traded fund. So guys, that was about the difference between an exchange traded fund, open-ended funds, and closed-ended funds. So that's the last kind of things which I'll be discussing of this topic, and that will be what are the advantages and disadvantages of ETFs over mutual fund. One has to actually finally decide which option to go for and which one to not. So it's always better to have your advantages and your disadvantages by your side while you judge and evaluate the options. So advantages are simply ETFs can be traded on stock exchanges, whereas mutual funds cannot. The portfolio underlying ETFs are always same and available for investor monitoring. They can be checked for accuracy and effectiveness time and again on real-time basis. That has already been discussed with you. Apart from that, the ETFs are as simple as transacting equity shares. I have already told you about this fact because that's an added advantage which comes with ETFs. So each time whenever you think about or ponder about buying a stock, next time think about buying an ETF rather than a stock. That may help you out in finalizing and evaluating a decision to go for ETFs over mutual funds as well. So what are the disadvantages, guys? Though they are pretty less of the disadvantages which are involved in case of ETFs, but absolutely it is being correctly said that with all the pros definitely comes cons in the picture, and that are brokerage commission on ETF shares. One has to pay the brokerage commission on ETF shares just like the normal equity shares in the market. One has to pay that. Plus, ETFs are by their structure a reflection of the prices of the basket of the stocks originally created. So I can simply say if the index will go up, your investment in ETF will go up. If index goes down, your investment in that ETF will go down. So you are directly connected with the index for that matter. So in any case, you won't be able to have that kind of perfect returns in terms of directly investing in particular sector or particularly a direct company. So in such a case, you will be having a dedicated kind of portfolio that will be directly aligned only on stock index. That can be treated as an advantage, but mostly in such a cases, people usually deem this as a disadvantage for them as well. But believe me, guys, certainly the market which is today won't be there 20 years down the line. Certainly, India is a growing nation, growing economy. It is going to grow at a very steady and increasing speed for that matter. And certainly, one will be able to extract good amount of returns in such a cases. I'll be concluding my video with a dose of motivation, and that is, I will win. Not immediately, but definitely. There can be a chances where people are likely to flunk in CA final day in day out. They are trying their level best to clear the CA finals. They are dealing with so many problems in their obstacles in their lives. However, I can simply say that one has to have this kind of attitude in their respective lives. Even if he is not a CA student, still one has to have this kind of attitude that he or she will certainly win. That might be a case that they won't be able to win immediately, but yes, definitely they'll be able to win one day, and success will definitely be theirs in such a case. And one has to have that kind of positive and optimistic attitude with themselves. With this, I'll be saying thank you on behalf of Edupedia World, guys. Keep interacting, keep showing your love, keep showing your your questions, your queries in my comment boxes. That will help me in staying connected with you guys. That will help me in understanding your needs. And I want you to clear your CA final examination with flying colors. Love you guys. Take care. Bye.